Okay, in this video, we're going to be talking about the ICT optimal trade entry. What is it? How do we use it? So that's what we're going to be doing. So the ICT optimal trade entry is, in simplest forms, it's the 62% retracement on the Fibonacci. Now, here's the deal. You don't want to not every retracement is going to be something that you want to trade though. So you're not just going to plot your Fibonacci on some random low and then take it to the high and then grab every 62% retracement. That's not an effective way to trade, okay? It's only useful when used in the proper context. The Fibonacci is, or the optimal trade entry is. So for example, what are some times that you want to use the optimal trade entry? Well, let's just take this Bitcoin, for example. So I just posted this Bitcoin a second ago in chat, and any of you guys that want to join that chat, or if you want to join my free Discord chat, there's going to be a link to that in the video description that you can join. So I just posted this Bitcoin the other day, and you can see we came up right here. I want you to look right here. We're trending up higher. Let me actually put in a replay real quick. So we're going to take our focus over here on Bitcoin. It's trending up higher. And as I said in chat, I think it's going to come up, take out this upper liquidity. And then after we take out that liquidity, I want to see it followed up by a shift in market structure, because overall it's bearish. Overall, the trend is bearish. And we have these buy stops right here. So what we see end up happening here is Bitcoin ends up trading up and it takes out those upper buy stops. As you can see, it pairs that level. After doing so, we had a shift in market structure to the downside. Now, this is where you use the Fibonacci. This is where you use optimal trade entry. This is the best time to use it. It's to use it whenever you have a shift in market structure. You can use the Fibonacci just for like basic continuation plays as well. If you have the market structure backing you, you can do that. But the best place is when you got something like this, where you have a pair, or you have a stock, or you have, in this case, crypto. It doesn't matter what market you use. It works in all markets. When you have something like this, where the bias is bearish in this example, the higher time frame market structure is bearish. So my advice, use multi-time frame alignment and make sure you're trading with the correct market structure as well. So that's number one. Number two, you want to see a liquidity grab. Having that liquidity grab prior to your shift is going to improve your odds of success dramatically. So like I just pointed out, we had these upper buy stops right here, because this is a swing high level. We take that out. We take out those buy stops, and we follow that up by a shift in market structure to the downside, because we broke this swing low level, broke these swing low levels. And then we had a fair value gap created on the break lower. So you can see right here, after we got that shift, we had a fair value gap created. So this is a prime scenario. This is a perfect scenario of a high probability shift in market structure, because we took liquidity, we had the shift, we had a high probability shift, we got the fair value gap. This is where you use that Fibonacci. This is where you use optimal trade entry to get the best entry. So for example, let's plot it on there now. So we're going to take our Fibonacci. Here's how you draw on your Fibonacci. You're going to take it from the high to the low of the impulse swing, and you're going to measure that price range on the displacement. You're going to measure it, and you can just ignore this lower portion. I got these exact Fibonacci settings from another strategy that I'm gathering data on at the moment. But all you need to focus on at the moment is the 62% retracement. See that? Right there. If you look at my cursor, look where it's moving. That's 62%, which is optimal trade entry. Once price trades up into 62%, that's where you would get that entry. If you're using the optimal trade entry as a means of getting an entry, you would get it in at 62% retracement. Again, you're not just grabbing any Fibonacci retracement to 62%. You're not just plotting your Fibonacci on random highs and lows and just doing it like that. No, you need the market structure back, and you need the bias. You need all of that. You need the draw on liquidity. You need all of it. And whenever you have everything in conjunction the way that you want, then you use that Fibonacci as a means of an entry, of minimizing your risk, because you can get your entry at 62%, for example. So it comes up, let's say it comes up. Did it come up and hit 62%? Give you optimal trade entry? It did. See how it spiked right there above 62%? You would have got in short right there. Okay, where would your profit target be on something like this if you're using the optimal trade entry? A good profit target, again, it's up to you. It's 100% up to you. But if you just want to target this internal range liquidity, you could just put your profit target right at the low of that impulse move. Or if you're trading with that higher time frame market structure, for example, like we are here, and the 4-hour chart is bearish, well, then you can target external range liquidity and maximize your reward a bit more. But that's for another video. Again, we just want to go over the Fibonacci in this one and how to use the optimal trade entry. So we come up in 62%, boom, that's where you get your entry. Your stop would be above the high of where you plotted that Fibonacci, and you would target that low. Okay. And then you just let it just works. It works and it's still yet to hit it, but that's the basis behind the trade. That's how you would use it. All right. So let's look at some more examples. That's just one, but let's look at another example here. Let's go to Euro USD from the other day. All right. So Euro USD, this is from the other day. So you can see this market structure on the 4-hour chart. Again, this is important as well. I recommend you have multi-time frame alignment, so at least one higher time frame chart and at least one lower time frame chart. And this 4-hour chart on Euro USD is currently bearish, and it was bearish yesterday as well when we had this set up. So the other day, what we saw happen here on Euro USD is we tapped up into this bearish imbalance. Market structure bearish, and now we're tapping up into an upper imbalance. And something that we saw happen the other day was we had this uptrend during London session, and we had this Judas swing take place during London session. So remember, Judas swing is just a fake run in the opposing direction of where price really intends on going for the sole intention of taking liquidity. And this Judas swing, it popped up into that 4-hour bearish imbalance. And during this time, this 15-minute market structure, I want you to note that it was operating within a bullish market structure. But somewhere along there, we had a change in trend. So we had that change in trend, which was right here. This is where that shift occurred after we came up and we rebalanced that price action. Let me remove it so you can see it better. We had that move lower. We broke that swing low level right there, and we left fair value gap confirmation on the break. That is a high probability shift in market structure. Why is it a high probability shift? Well, for a few reasons, we're aligned with that 4-hour higher time frame market structure. It took liquidity beforehand. It had a fair value gap confirmation on the shift, strong close. It has the whole deal. And London session as well. So it happened during London session, which is a bonus too. Because a lot of times, as you'll see, London will set the trend for the day going forward. So I want you to think of it like this. Here's a really good way to think about it. I want you to know the absolute high that was made prior to that change in trend, prior to that shift in market structure. This will always be the best place to keep your stop. The high of the liquidity run, the absolute point where that change in trend occurred. Remember, guys, this 15-minute right here was bullish, operating within a bullish market structure. And then you get a shift to the downside. You get a big explosive shift to the downside. So this was the absolute high of that change in trend. That's where that shift originated at. And if you were a short, this was the best possible price, right, on this surge up right here. Then we had that move lower. Okay, we trade lower and we continue. And then coming into New York session, because there's a few different times that you'll see Judas swings. You'll have it right after midnight, which is what we had right here. So during London session, and then you also have Judas swing. A lot of times that'll happen during the beginning of New York session, which will typically give you that retracement within the range that's created during London to get on board that continuation. So remember, where did that shift occur? Let's get our Fibonacci, because now we're about to get an entry. We're going to take our Fibonacci from the high that was put in during London session, because that's where that liquidity run happened. That's where that Judas swing happened. And what we do is we take that high and we draw our Fibonacci from the absolute low of the retracement. There's 62%. That's where you would get your entry right there. That's during New York kill zone. It comes up into 62%. It grabs that upper buy side. That is where you would enter. That is where you would keep your stop. And if you just want to target that liquidity right there, you could keep your profit target right there, or you could target that external range liquidity. But that's how you would go about doing it. 62% would be your entry. You would draw your Fibonacci, because you would draw your Fibonacci from the absolute high of that liquidity run of the original shift, and you would take it to the low. It's not the only way you could use the optimal trade entry. I'm saying like that is like the highest probability way. The highest probability way is by using the top of the liquidity run, is by using that original shift like that and having that higher time frame bias backing you as well. It's higher probability when you have that scenario. You don't need the liquidity run, absolutely. If it's like in a very strong trending environment, there's a time and a place. Like if it's in an extremely strong trending environment, sometimes you can just use the most recent low and then grab that retracement back within the range, and it'll just keep trending up higher because it's extremely strong trend. But a lot of times that's not the case, and your best bet is to use the liquidity run like we got right here. And a lot of times those key liquidity runs like we have right here, they'll happen during London session, because a lot of times the highs put in during London session. So what you really want to see is that liquidity run during London, aka that Judas swing, and then have that shift in market structure later in London, which we had right here, which sets the trend for the day going forward. And a lot of times what you'll see next is you'll get a retracement that happens during New York session, aka your mini Judas swing within the range that's created during London session, or some people call it turtle soup, potato. And we come up, we take out the upper buy stops, and you can see it gave you 62%. So you could have got on board. You could have got on board that short right there as soon as it hit 62%, stop above the liquidity run, which many times put in during London session. London sets the trend. So your high would be the top of London, and then you would targets lows. So you can just look for that criteria right there. That criteria it happens, it repeats, and it is high probability when you have everything in conjunction that you want. So that's how you would use the ICT optimal trade entry.